Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Themes ETFs, a new ETF sponsor, offers products that seek to provide investors with a way to own the opportunities that are shaping the future and moving markets with expense ratios that are 40% cheaper than the average charged by its competitors. The offerings at Themes span both cutting edge technologies and traditional industries with targeted exposure ranging from generative artificial intelligence to cybersecurity to airlines to banks. Backed by a former co founder of Global X and a team of dynamic portfolio management professionals who collectively bring decades of experience and extensive expertise to managing ETF portfolios for multi billion dollar asset managers, Themes ETFs aims to disrupt the market with its competitive fee structure. Themes ETFs has foregone a traditional wholesaling model to minimize its distributional expenses and maximize cost efficiency, passing those savings directly to investors in the form of lower fees. And my guest today is Taylor Kraskowiak. He is a vice president and the investment strategist at Themes ETFs. So, Taylor, I'm going to start by asking you to tell me about your career path, what led you to Themes, and a little more about your role there.
Thank you so much, Bob, and want to thank you personally first before we get into it for having me here today. It's a great pleasure to be with you. Really excited to discuss some of these strategies. And again, really can't thank you enough for the opportunity. So to answer your question, for me personally, one of the things that is most fascinating to me about financial markets is I've always kind of viewed them as this quintessential unsolvable equation. It's a million constantly changing variables, very few constants, and it's one that will always keep you on your toes. No matter how much you think you know about it, it tends to surprise even the most tried and true veterans in this space. So it remains a very dynamic space and one where there's really rarely ever a dull moment. So with all of that said, that's initially what attracted me to the industry in the first place. And I was very fortunate to be able to sink my teeth into macroeconomic analysis as an investment strategy analyst at Raymond James, and then derivatives and options products when I worked at SIBO Vest, which primarily focused on those sorts of buffer derivative-based investments, before ultimately joining some of my former colleagues here to start Themes ETFs and giving investors, I think, some access to some of the most promising parts of the market at some of the most competitive price points possible.
Well, markets certainly are a mystery, and let's try to unravel some of that in today's podcast. Let's start with some definitions. What are thematic investments? Why are they relevant in today's market?
Well, I think themes can be interpreted quite broadly when we take a look at what thematics mean. I think the most basic definition we can use is a access and exposure to a particular segment of that market. So whether that be something like artificial intelligence, cybersecurity, banks, airlines, it really ranges from, again, the cutting edge technologies to traditional industries. It really allows you to make a targeted play rather than buying a broad-based index, for example, like the S&P 500. That is, I think, the significant dichotomy between the two. And as to why they're relevant in today's market environment, the thing I'd like to look at is really the fact that we find ourselves in a very much so a tale of two markets. And really the bifurcation I see between those two markets is the period immediately following the great financial crisis through 2022, when we actually had the emergence of inflation. And during that period, the Federal Reserve kept interest rates at 0%. It was a zero gravity environment where everything tended to float higher, irrespective of asset class. As long as you were putting the money to work in pretty much anything, including broad-based indices, you really couldn't go wrong. But now we've seen a pretty significant shift post 2022. Obviously, the Fed has had to raise interest rates to try to get back in front of the eight ball after inflation came up. And as a result, they've reintroduced gravity into the system. And here we find in this environment, not all stocks, not all sectors are created equal, and it's having a disparate effect on different segments of the market. And some have done well and some haven't. And that's where actually themes have really started to shine, is in this environment post 2022. And we've seen some outperformance of these particular themes relative to broad-based benchmarks like the S&P 500. So this really is, I think, an incredible time for the thematic space to really shine in a world in which you have to do your homework and find the stocks that can overcome that gravity that's reintroduced into the system.
Tell me about the motivation. Why did you launch themes ETFs in a market that is clearly already saturated with thematic based products?
Well, here we saw an opportunity to provide values where we felt others had fallen short. While there are many players in this space, I'd like to think that the thematic space is still relatively nascent. As such, it has one of the greatest hallmarks of a nascent segment of asset management, in that fees are still fairly high. When we take a look at the average expense ratio for thematic funds broadly, the average is about 60 basis points. As we know, that's kind of a far cry from the low cost index ETF solutions that investors have become very familiar with and tend to gravitate towards. And this is where we feel like we've tried to take a page out of Vanguard's playbook and stepped into the space to provide that more competitive fee structure and really push the maturity of the thematic space into its next chapter, which is really providing that cost efficiency onto investors.
Your differentiator is that you're low expenses. You want to be the vanguard of the thematic industry world. What are your expense ratios?
So we've come and priced our funds at 35 basis points, which represents a 40% discount to that 60 basis point average that I just referenced. So this is the price point that we felt that we could come in competitively while at the same time offering a viable business model, specifically offering that portfolio management, the institutional grade style investment management that you should come to expect in any ETF issuer, while at the same time trying to deliver that cost efficiency. We found the sweet spot there was at that 35 basis points level.
It seems to me that you're in a market that has been largely commoditized. Uh, the power behind thematic ETFs, like all other passive ETFs, is algorithmic. There's no human decision making involved. And as you've noted, the primary way in which you compete now is via price. Why would you choose to compete in that commoditized industry where there could very well be a race to the bottom when it comes to price?
I think it's a very fair question. And, I think the answer is twofold. And this is something that we genuinely and sincerely believe at Themes and have really made it our mission, because we do think that investors deserve the most competitive cost possible. And obviously, in some of the offerings, they're not getting that currently. And this is where we've really tried to differentiate ourselves in this space and really kind of bring that conversation up in the thematic space in terms of the effect that fees play. And the other thing is I think that in particularly in this space, this goes back to that tale of two markets, right? In the that first period, we I think got very spoiled by double-digit style equity returns. Again, it was the market continued to make new all-time highs year after year, and again delivering those sorts of double-digit returns. And I think in this environment where growth may be a little bit more challenged, I know that the Federal Reserve has hit terminal on their rates, but interest rates still aren't zero. And as a result, we're likely going to see that returns are probably going to moderate going forward. And in that environment where there are relatively lower returns, fees matter more. So I think all of those reasons. Create a world in which there's a confluence of circumstances that make our offering attractive in this space at this time.
Well, I applaud you for your efforts to drive down fees. As we've written very often in our publication, fees are the primary determinant of investment returns, and all else equal, we always want lower fees. What makes your products unique other than their lower fees? What is your full value proposition at the issuer level?
Yeah, obviously, I think it's the easiest one to talk about in terms of the fee differential. It's a very easy stat to rattle off. But beyond that, I think when it comes to taking a look at what we offer as an entire package, that really is making and constructing a better strategy wherever possible. So not only have we come to market with all of these themes at more competitive price points, we, wherever possible, have tried to perfect those themes. And a good example is the airlines ETF, for example, that we just launched, ticker symbol AIRL, only the second in the space. But in producing that ETF and generating that exposure, one of the things that we've done is taken a lot of time to look back over history and see what sorts of index based methodologies and rules based methodologies yield the best results. As we all know, past performance is certainly no indicator of future results. But that being said, I think wherever possible, if you can perfect your index methodology, the rules that you implement in constructing a strategy, it will ultimately, all else being equal, give you better odds to try to perform in this market where we know returns are going to be a lot more challenging to obtain than they have in years past. And this is where really have to credit the incredible product development team headed up by my colleague Calvin Sang, who has done an incredible amount of work over the last year, working very closely with our index providers to, again, try to build a better product, build a better index wherever possible.
So I think U.S. Funds is the other ETF provider that has an airline ETF. Uh, so talk about your product development approach. What is it about the design and the construction of your ETFs that makes them noteworthy?
So I think again, when we take a look at the ETFs and the strategies themselves, we've taken a really long, hard look at both diversification. So, for example, taking a look and making sure, I know everyone likes to talk about the Magnificent Seven, but using our artificial intelligence ETF as an example, ticker symbol WISE, WISE, we've tried to diversify beyond just those mega cap names into 40 different names, and we've seen that work very positively, I think, when you compare that strategy relative to the NASDAQ, because by including some perhaps lesser known names, but ones that are very much in the space, you can really reap some rewards from a valuation perspective. For example, if you're just buying Google, Amazon, Nvidia, some of these really big names that have already run up quite a bit, it makes the return calculation a little bit more challenging just by virtue of their valuation. So when we take a look at, that's a small example of how we've tried to incorporate diversification across all of our themes. It's not just a handful of names. We really truly try to, split the difference between targeted exposure, while at the same time giving you sufficient diversification that may give you an opportunity to have a little bit of an edge when you take a look at valuations. And then, separately, the thing that we've tried to do is also take a look at the triggers for the index methodology themselves. So, wherever possible, how can we create a universe of those names that is going to be as selective as possible, but is going to be as strategic as possible as well? So, what are the triggers? What are the criteria that are ultimately going to yield perhaps some of the best names that give you some of the best potential and opportunity to perform in this market environment?
So you mentioned your generative AI ETF. I think the symbol for that is WISE, WISE. Talk about your lineup and what elements of it are you do you think are noteworthy?
I really appreciate the question. We are very excited to unveil. It's been quite the undertaking for the team over the last couple of weeks, but we've launched 11 funds, and those 11 funds span a pretty wide breadth of different themes. So that's everything from, like we discussed, AI, cybersecurity, cloud computing. At the cutting edge of technology, all the way on the other side of the equation, we have things that are much more traditional, things like airlines, things like banks, things like European luxury brands, and then also a suite of fundamental ETFs as well that optimize for things on the balance sheet. So things like natural monopolies. So that's our ticker symbol ZAR, CZAR, is going to be focusing on those companies that have pricing power in their respective markets. Also, taking a look at profitable research and development. That's going to be our ticker symbol USRD. So, taking R&D as a theme, but then overlaying a profitability criteria to take a look at the best and brightest names in the space that are also yielding a positive return on the balance sheet. So finding that synergy between the two, I think, is really a testament to the innovations of the product development team. Again, some of these great creations that Calvin has come up with. And then finally, I think, one of the other noteworthy products, we're very excited. I know some of them have been second of their name, but this one is actually the first of its name. And that is the ETF that we unveiled that gives exposure to the global systemically important banks, GSIB. So that's both a term that's used by the Financial Stability Board, which is where these names come from. It's also the ticker symbol of our fund. Again, ticker symbol GSIB. And that gives you exposure to the 28 publicly traded again, global systemically important banks. And that's, I think, a perfect example of where having a exposure to the best banks in the banking industry. It's not just the banking sector as a whole. It's going to target those systemically important institutions, and as a result, give you a play on the banking industry that's not nearly as broad based as simply buying a banking index. It's giving you a much more targeted exposure to the big names in the space.
So we're going to include some links to the fact sheets for some of the ETFs that you mentioned. Do you own and manage your own indices, or are you licensing indices that have been developed by others?
So yes, we've contracted with Solactive, a German index provider. They're very, very well known in the thematic space, and they've been incredible partners to work with in developing these methodologies. They have been an incredible resource to really, again, kind of refine and optimize these strategies. So a huge shout out to our partners at Solactive that have really made it possible to bring forth all of these ETFs. And all 10 of our ETFs, with the exception of the GSIB ticker, all track Solactive indices that we've launched. So they're all going to be passive based investments tracking those indices that we've worked with Solactive to construct.
There has been academic research that has shown that thematic ETFs as a group have underperformed. And the explanation is that those products are released after the hype for that theme has peaked and the ETFs fail to capture the initial excitement about the theme. What do you say to a skeptic who has read that research and believes that thematic based investing is just an overhyped, overpriced version of sector based investing?
It's a really fair question and one that I think deserves a fair answer. And going back to my earlier point, again, we can't discount the fact that this is truly a tale of two markets. I'd like to also vindicate the research and the point that a lot of people have, and I think it's a valid one, that it was absolutely true in that first market environment from 2008 to 2022. It was very, very hard to beat the broad based index benchmarks. Let's just be honest. So you had to pick the right names, and even so, you were trying to keep up with an index that was working at breakneck speeds, and a lot of times those high fees ultimately dragged the return. So you'd buy a thematic investment exposure and ultimately unperform the benchmark and question, well, why do I even own this? But we have to remember that market environment's in the rearview mirror. It's a completely different landscape in the post 2022 environment where it's no longer zero gravity. Gravity has been reintroduced in the form of higher interest rates, and thematic exposure has actually performed extraordinarily well in this environment. It takes no introduction here. Take a look at AI. That has been by far and away the talk of the town and has powered so many of these, returns. And having a targeted exposure to AI actually gave you a great edge over those broad-based market benchmarks. And so when we take a look at actually all of our thematic strategies, and we measure how those strategies have performed circa the market bottom in October of 2022, and we see which ones of those have led the recovery. 10 out of 11 are either neck and neck with the S&P or outperforming, and a handful of them are even outperforming the NASDAQ, things like artificial intelligence and cloud computing. So I think it's important to make the distinction of the market environment. Again, we always say in this industry, past performance is no guarantee of future results. So, this is where the sword cuts the other way. That perhaps the lackluster performance of themes in that environment from 2008 to 2022 isn't necessarily the best yardstick to be measuring how themes are going to perform in this new market environment, the one in which, again, there is gravity and not all stocks and sectors are created equal. Going back to the GSIB example, this is a perfect example how, sure, if you show how the banking, index did relative to a broad-based benchmark, it was hard to say that you could outperform. But this year was a totally different environment. You did not want to be holding Silicon Valley Bank, Signature Bank, during the crisis that we saw earlier this year, where all of those small cap banking names found themselves in a lot of hot water and some went under. By contrast, you wanted to be in the big names like the JP Morgans that were actually brokering those bailouts, or the UBSs. And that is what GSIB gives you exposure to. It's giving you exposure to the big guys, while at the same time kind of stripping out the smaller names that have actually been a drag on the banking index's performance. So that's another, I think, great salient example of how there is a bifurcation, and that how targeted exposure can actually benefit you in this environment where, again, interest rates are a sword that really kind of separates those who can survive and those who can't. And I think this is an opportunity for you to really be on the right side of that divide.
If there's one key takeaway that you'd like to leave with our audience of advisors about how they should go about evaluating thematic ETFs such as yours, what would that be?
So I'd say, I think across the board, own the opportunity. And what do I mean by that is that with obstacles come opportunities. There's really no way to sugarcoat this. This environment is a lot more challenging relative to the environment that we had. If we're all honest with ourselves as asset allocators, you really didn't have to do a lot of homework in previous years. Again, in that environment from 2008 to 2022, as long as you had a decently diversified exposure, you were putting money to work, you really couldn't go wrong for the most part. And it was very easy. We could, kind of put things on autopilot and coast. Now, this is really, I think, an opportunity for asset allocators, for advisors, for real people to show their value, both to their clients and in their allocation process. And this is where those who take the time to do the homework, to find those opportunities and find a way to own those opportunities are ultimately going to be served far better than those who think that they can just throw money at an index and hope for the best like they did over those last few years. So again, I think this is an environment where there is opportunity, and that opportunity will reward those who bother to do their homework and to really take the diligence that is required to succeed in this market environment.
We'll include some links in the notes that accompany this podcast where you'll be able to learn more about Taylor and about themes ETFs. There'll be a link to the themes ETF homepage and its ETF lineup. There'll also be links to four of the ETFs that Taylor mentioned: WISE, WISC, the generative AI ETF; SPAM, SPAM, the cybersecurity ETF; Airlines ETF symbol AIRL; and GSIB, the Global Systemically Important Banks ETF. And there'll be a link to meet the team behind Themes ETFs. Taylor, is there anything else you'd like to add?
The only thing I'll say at this point is a tremendous thank you to you and the Vetify team for having me on today. It was an absolute pleasure to sit down with you, and a very warm, sincere, happy holidays to you and the team, as well as all the best wishes for the new year. Thank you so much for your time and consideration today. It was a pleasure to be with you.
Well, you're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Hoopsher. Today featuring Taylor Kriskoviak of Themes ETFs. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.